Are we streaming? I see no picture.
Give it a hot second. It's thinking.
So full face. This is probably... Oh, shit. Okay, here we go. There we go. Hopefully this thing's connected. Yeah, we're good. We're good. We're good. Tim's just waving. All right, guys. Sorry we're late. I just had a phone call from the state police and had to go deal with that. Apparently, the neighbors were upset that my car was parked in front of their house, even though it's technically on township property. And he was in the process of getting it, writing up the paperwork to tow it. So that is why we're late. More on that probably later.
Real world.
Real world, man. Real world. Crazy.
Well, this delay is hilarious because I'm like, I'm not moving. What's going on?
Yeah. So you have your thing up. I don't know how to even tell chat stuff. So because we're going to be looking in Schwab. I didn't even log into freaking Schwab yet. Cool. So behind the 8 ball, guys.
Don't do this on live.
I'm not live. I don't have much screen sharing. Oh. Don't do this live.
Don't do this live.
Okay, so Tim, start talking about what the heck you got.
Yesterday, everyone yesterday we did some shopping and we did one little follow up on that. This morning I forgot one of the ones that I wanted to get.
Do you want to buy that now?
I got it already.
Oh.
So I went in and I bought it. It's OPRA. It's Opera. It's the.
How much did you put into that?
$3,000.
Okay.
It only pays 2 dividends a year. It pays a dividend in January and it pays a dividend in July, but it's like currently like $13 and it should be like in the 20s, so like it's severely undervalued.
Okay, so
that's that. But here is our
we're gonna switch over to scene.
Our high yield portfolio at the current moment.
All right, so we had like 20,000 in here before, and we just put 30,000 in from the condo proceeds to allocate into the rest of the thing. We told you yesterday that if you didn't tune into the live stream for the main portfolio, we had 100,000 into that, and we moved 20,000 out of that over into this, sub brokerage account, because this is going to be our income generating portfolio that we're going to be living off every month and spending our cash, while our core portfolio that was 80,000 plus 120 that's eventually going to be invested completely. We only did 30,000 yesterday because valuations were not appropriate, or I guess 33,000. Valuations were not appropriate, so that is actually going to be we're going to be getting into that over the time frame to get that up to the full, what is 120 and 80, 200,000. So that'll be a 200,000. I know I can't do math. That'll be 200,000 once that's all said and done, completely invested. Right now we're waiting for valuations.
200. I got it. I added it on my hand
to come back into wherever. So now today we're going to be doing the Round Hill. It's mainly Round Hill, but high yield strategy.
It's all Round Hill.
The reason we have a lot of yield max in the current portfolio, or right now, is because yield max was the only thing available when we first started doing these strategies, and we've held a lot of these 2 years at this point.
It's been a while. Yeah, here I actually pull up the actual. Coney, we've been in for 27 months.
Okay, so 27 months on Coney, even though it is just dying at this point.
Fiat's only 8 months. Fiat's trash anyways. NVDY, we've been in for 28 months as well. And YMAX has been 21 months. So that one, we have about 55% of our initial recouped. This one we have LFGY, which is a yield max crypto, but this one's different than the other yield maxes. This one they actually hold companies in, so they kind of they do that covered call on the companies they hold. This here's the index fund of all yield maxes. So if you're for whatever reason, I don't know, crazy, I don't know, and you want to have like every yield max that they have, you buy YMAX because it's basically the index fund of all the yield maxes. The LFGY is the crypto one that I just mentioned. Coney, I've actually recouped my money twice in Coney, so like I understand that it's a lot of people don't think it's feasible. A lot of people don't think it's feasible, but I've actually put money in there twice and actually recouped my
full investment. So everything that's in that Coney, I think, other than our other experiment, right? Because that got lumped with some of this, but how many shares was that before?
It was 11, so I had 110 total shares of the Coney one that was paid off, and I moved it over here. But because I did a reverse stock split, we're at 50 now.
So what does that make? That one share? You said we had 11.
11. We had 39.
Oh, okay.
We had 39.
So 11 of those 50 shares is actually all paid back and completely like house money. generating profit.
This one here I have about. This is the Round Hill Bitcoin cover. This is they do covered calls on the IBIT. This is, remember, we discussed this where IBIT, like, you got no money. It was literally just all price appreciation. So I transferred all the IBIT money into YBTC to actually make a at the time monthly dividend, but now it's a weekly dividend. That one we're about 60% repaid. USLY I'm working on. I'm about, that one's the Defiance. That's just a oil one. Don't worry about that one. This one's all profit as well. So we have 106 shares of NVIDIA that's all profit.
So we have no actual cost sunk into that.
So this one is actually one of the 9 I think actually has ran pretty well, is the NVDY.
Of the YieldMax. And yes, YieldMax really are trash. I think he commented in the last podcast episode that only 9 of the like 60 some that they actually have out right now hold any of the actual share that they're doing trades or like options calls on. And those, based on what we've seen with Round Hill and what we're even now seeing with YieldMax, those definitely hold up from the NAV decline component.
Better.
A lot better.
Yeah. I mean, the AMZY is completely paid back. So this is all, these 47 shares are paid for, all profit. WNTR I'm about 80% repaid on, but I didn't really put a lot into this, so
that's a newer one. That's a newer one. So that one hasn't had time to actually recruit. Fiat's probably going to be one of the actual few that we didn't actually make our money back on. TSLY, did we actually sell that completely?
Yeah, I got it.
So TSLY we did lose money in, and we sold it for a loss because we just basically decided to cut that and put it in other investments. So there was one that we 100% locked in the loss. Fiat might end up in that boat, but as of everything else,
I don't know.
Other than WNTR, because it's new from a YieldMax perspective. So yes, the YieldMaxes are sketchy. Oh, we don't have YMAX payback yet, do we?
No, YMAX we're working on.
Okay. Do you know what percent that one is actually paid back?
Probably 55 to 60%.
Okay, so we have about 55-60% of that one paid back, so that one's still in the boat. And again, until these things go to zero, you have time to actually recoup your initial investment and then end up in the profit thing. If you look at these like you're starting a small business or buying like a trailer that you're renting out, that's essentially how you have to look at these things. They're not normal dividend stocks. They are not things you want to turn your drip on in. We've said this over and over and over again, and people, yes, they're scary, but if you treat them with the right strategy, you can actually make out in the long term.
You can, because they do pay weekly. So the weekly payments are a little bit less than what the monthly payments were, generally. Like not in every one that's a weekly payer, but at one point these all were monthly payers and they paid pretty well. That's how I was able to generate enough money to get my my initial investment recouped in NVDY, CONY, and AMZY, because they used to be paying a lot more. But now they do weekly, and it's probably the weekly dividends, and from what I'm seeing, are probably 75-ish% of what the monthly payments were. That doesn't seem like a whole lot, but whenever you have a lot of shares, it does actually equate to a pretty good amount. But today we're actually going to be putting $30-some thousand into this one, Coinbase, for the Round Hill, the Tesla for the Round Hill, the NVIDIA for the Round Hill, the Palantir for the Round Hill, and WPay, which is the index fund of all the Round Hill things. I see we are, so like technically we are double dipping because we have all these other Round Hills and we have this one here.
Yeah, YPay is an index fund of all the Round Hill ones. Now, so Tim didn't come up with those just willy-nilly. He's been actually doing research for quite a few months, planning this whole thing for the condo, and he's been watching the price valuations and the dividend payouts because he signs up for Round Hill's weekly payout thing that comes out on Fridays, which is why we're doing this today, because we just got the listing for today. I think you said that the payouts coming Tuesday are lower than they normally are.
They're a little bit lower.
Little bit?
A little bit. Probably.
But these do fluctuate.
5% lower than what I'd like to see, but like they do fluctuate. They trade with, like, normally the dividend comes within a band of like a low 20 cents, something like that, and then a high of like 50 some cents like that. And like these ones here are kind of like not quite where I want them to be, but they're still okay. Then like the price depreciation you see with WPay, that's actually held up pretty good. It's currently at 43.58, and we bought it for 46.86. Palantir is actually more than when we bought it, so that's good initially. Apple's
Coney's the one that's the
more,
worst.
but that's not one we're getting into. That one, the dividend's too low for that one. I wish it was higher, but it's too low. You're only getting 15 to 23 cents a week on that one. NVDW is a lot less, so that's why we're doing some dollar cost averaging today, as well as funding future travels. Tesla is about where we got it before, and Coinbase is a lot lower, but that's because Coinbase itself is a lot lower. Now I want to show you why I prefer the round hills before we get into the trading part. We'll just click on this Tesla one. Why I prefer round hills over yield maxes, in case anyone cares.
Everybody should care because they keep telling us to be careful, be careful, be careful, and you see stuff all over Reddit.
Like right here's why.
They own actual TSLA stock, 25% according to their net asset.
So they actually in their single payer stocks, generally they actually own underlying stock of the company.
Yep, this
whereas yield maxes generally, now again, generally speaking, not all of them obviously, but generally speaking, yield max does synthetic calls on the underlying asset. So they actually don't hold any of the stock. What they'll do is they'll write an option above the price, and they'll write an option below the price, and that's called a synthetic call, where like you actually don't own the asset, but you kind of do on paper because you have both the high and the low covered. I don't like that. From what I'm seeing, that doesn't actually equate to very good returns with the synthetic call stuff in yield max. It could very well be something that's lucrative and productive in other investments, but in yield max specifically, that's why I've kind of like pivoted from yield max into round hills, because round hill actually has a portion in stock. Now that's the weekly pay swap. Like I tried to describe this in the newsletter that we publish every week. It is, they go to a bank and say, hey, we'll give you X amount of dollars if you pay us X amount for this stock being higher than it is. So it's like they use an intermediary, which is normally a bank, and they say, we're willing to give you $500 if you're willing to give us 2% gain on Tesla stock. It's a weird little thing they do, but they do it every week, and I don't know, it seems to be working because round hills is much better high yielders than yield max. And what's the other one that's a high yielder? We have Rex shares. Rex shares are doing pretty well, but they actually...
You kept them in the main portfolio though, didn't you?
Yes, I did. FEPI, AIPI, and CEPI are Rex shares.
And the reason for that, I actually asked this for him because I was curious too, because they are higher yielders. He said that he wanted to accrue more shares of these, so he's going to actually have the drip on in those, so he's considering that part of the core portfolio and not the...
Well, that's my backup plan to my backup plan to my backup plan.
Yeah, and I was just going to say, I'm going to reiterate here in case you didn't watch the other live stream, but the whole point of breaking this into two separate portfolios, essentially, the main portfolio is the money that we're going to allow to continue to compound and continue to grow over time as a fallback, so that if the round hill strategy or the high yield strategy does not work, or it ends up going to zero at some point and we lose all of the seed capital in here, we have something to fall back on. But the high yield thing is allowing us to essentially replicate or supplement a paycheck so that we don't have to touch the core portfolio. So we're essentially taking a portion of the proceeds to generate income to live off of, and that is literally what from
should have the phone up so we can see
the next pay.
Oh,
so that's what I'm doing over here. I haven't seen anything yet.
Okay.
And that's the whole point of this. So we're going to be living off of these proceeds. So you'll see in future coming aspects on the podcast, or if we do other videos, you'll see that we're living off of the money that is in this portfolio over the other portfolio. The other stuff's just going to continue to get compound. And we're going to monitor this over time so that if the payouts do start declining, we're probably going to be putting more money into probably Rex shares or other aspects of the portfolio.
My backup plan is if this starts to go south, I'm going to actually take the Rex shares and transfer them over into this account. The Rex shares have held up quite nicely. We've had AIPI now for 13 months, and it's been really good. We've had FEPI.
Can you face?
4, 5 to 5 is 12. For 17, we've been in FEPI for 17 months, and it's held up pretty well as well. Those ones, they don't actually have the swaps or anything. They literally just have a basket of stocks. AIPI is a basket of AI stocks. FEPI is FANG stocks. They just hold a basket of the FANG stocks, and they write covered calls on what they're holding. Now the payouts are vastly less. They're like AIPI is like 35% yield, and FEPI is like 25% yield. But I'm accruing so many shares because I'm just having the drip on that if I need to, whenever I actually move them over, they should be able to replace a lot of our income if I need to. If not, then they'll just keep growing in the main portfolio, and then we'll have a good story to tell, I guess. I don't know.
Okay.
With all the,
I think all of that's been...
all that. This one here is trash, and I'll get into this one. I forgot to mention that one.
Which one?
The MicroStrategy one, because MicroStrategy itself is basically like 80% or maybe 85% tied to Bitcoin. So like when Bitcoin goes down, this one goes down. That's why you see it trading at $11 right now. When these all came out, these round hills, they were, I believe, all at $50. So this one's had a significant depreciation because the cost of Bitcoin has gone down so much.
I do also want to say that what we I probably should say this first. So we're still keeping a lot of the older ones because if we would cash them out and put them into something else, we'd be making less per week and month than we would be if we just held them and let them ride to zero, at least at this juncture. So that is why we still have some of these crappier ones still in this portfolio. It just doesn't make sense to do that flip around to make more money off of, because you just don't. And the other aspect is if you were investing smaller increments of money over time, what we would recommend is waiting for that list to come out on Fridays and then figuring out which are the best ones with the highest payouts to basically get into.
Yeah, she did mention that. Like, if you go into Roundhill and you just subscribe to their thing, they'll actually send you an email anytime any of the Roundhills has a next dividend coming up. So you do get a list on Friday of all the single payer ones, and it tells you exactly what the payout's going to be on Tuesday. So it's a way for you to get a head start. I get a jump start, I guess.
But we do not just get in the ones that are the highest payouts. He's been watching these for a really long time, so he knows if they're in like bands, and they trade in bands and things. So he knows when they're lower valued. So he does what we do with our main portfolio. We do that churning concept where we look at the valuations. We try to get in at the lower valuation so you get more quantities of shares, so you're getting more dividend payouts. And then we turn the drips off on all of these because we do not want them to automatically reinvest. One, because of that decline component. Two, because it's going to be our income portfolio. But even if it wasn't, we want to pick up shares at a lower value and not randomly when for the same stock or the same ETF, whenever the heck that the dividends come in.
So
so it's a manual process.
Illustrate a perfect example. Yeah. So Palantir, it seems undervalued because it's at $40. Its next dividend is going to be... Hold on, I know this. I should know this. Its next dividend is going to be 57 cents per share. So you're going to get you get a lump sum from that one. But then if you look down here, like maybe you like Netflix, maybe you like Amazon, but like if you look down here, this one's more undervalued. So like in theory, if you think that Coinbase is going to do well in 2026, I do. Other people may or may not. You can then take all your money you accrue from all your different roundhills, dump it all into Coinbase while it's severely depressed. And you can pick up more shares than you would if you just had the drip on and you let all these drip. Nvidia's, I believe, is 32 cents on Tuesday. You'll get a 32 cent per share. I think Tesla's is 45 cents or something like that. So like we're going to have a pretty big lump sum that we can... What?
Oh, go ahead.
Oh, that we can then dump into whatever one we want. Like this one, I really wish this one paid out more because this one's super good. The other one that I was thinking about doing would be AMZW, which is the Amazon one, because I think Amazon with their ASW AI stuff is going to be really good in 2026. But I just can't. Like Amazon, what is Amazon's for next week? Hold on, I have this written down.
You do have it written down. But one of the people who's actually following our strategy messages us every Friday and asks what to put her dividends into because she's putting them back in. And
Amazon's is 30 cents a share next week.
Yeah, the two that he picked this morning were AMZW and NFLW. So the Netflix one, and then he said which like shares he'd buy, and like we gave him limit prices.
The Netflix one, like that one, like because of current events, like you may or may not be on the side of like a bull in Netflix, and you might be on the bear because. If you don't know, Netflix is trying to basically buy Warner Brothers. So they have a streaming a streaming like empire, then they're starting to build like a movie empire. I think Netflix
is gonna
be pretty big, but again, they don't I don't get into it because it doesn't fit our strategy where we want to make enough money to live on the road on, because its dividends generally between like 10 and 25 cents per share, so its payout is way smaller than the other ones. But once I will probably start, if we don't use the money, I'll start like every month I might just start initiate a position in the Netflix one.
So like I said, we will be monitoring this to make sure that we're staying within our target.
But you'll see everything that we're buying today, other than the WPay. Like I think Palantir is going to it's just going to keep doing what it does in 2026. Nvidia, I think, is going to keep doing what it does in 2026. Tesla, I think, because of SpaceX and the robo taxis and everything, is going to have a pretty big 2026. And Coinbase, because I think my prediction, I could be wrong, don't hold me to it, but I think that crypto will actually make a rebound, and it'll actually be higher than it was in 2025 at some point in 2026. I don't know how long that'll be.
I have a little more reservations for this one because I think it's highly manipulated, since it is part of the whole thing. But that's what Tim thinks.
First one we're going to buy is this one here.
COIW.
Yeah. We want to have $5,000 total, so we have, what in this now? 300 and...
You're going based off money? You didn't just figure out a share quantity?
376, so we want... So 376...
Let's do math, since apparently I suck at it.
5,000. What did I say it was? Minus 376?
Uh-huh.
So we want 4624.
The most random. Estimated number of shares. Apply. And then order type limit.
I would just do the 2220 is good.
2220.
Mm-hmm.
Can we buy another share of that? No.
You can. Go ahead.
You want me to buy another share?
Yeah.
Ooh, good.
Okay.
Oh yeah, we can buy another share. Review. Everything.
But that's because I have a strong belief that crypto is going to rebound. The problem with crypto.
Crap! I don't know if I checked the reinvestment
that's
thing.
Fine. You don't I'll go in later and fix what that means.
Okay.
Problem with crypto is crypto was basically built on the premise that it's going to be decentralized finance. But then the people holding crypto wanted crypto to become mainstream so that they could make more money from crypto. But by becoming more mainstream, crypto itself then has more rules and regulations placed on it by the institution. So it's becoming less decentralized finance and more centralized finance. So like that's the that's a trade-off for wanting crypto to be mainstream, so you can make a lot of money.
Yeah.
Granted, there are cryptocurrencies out there that don't adhere to that, but like all the big ones are all part of all the big institutions now are buying the crypto. So that's the problem with that.
But you can still use the other ones for the decentralized component. So it's like you can have the best of both worlds if you choose to. But we're looking at this through the lens of making money. And if it is going to be the thing of the future, the government really is moving towards digital finance, digital dollar, whatever. So the next one's TSLW. How many shares do you want to have of this one?
4397.
And how many do we have?
Click on the quantity.
What the hell's the quantity? No. That's not what I was asking.
I don't know. Click on the little calculator thing there. 4397.
I asked how many we currently have, dum-dum.
17. 16.
All right.
Limit.
So 118, limit order. So you change the price.
Do 3708.
Okay.
Tack another one on. Review. Now this one I'm super high on Tesla stock itself, but I want to make income from Tesla, so that's why I pivoted to the TSLW, because if you hold Tesla stock, you're kind of at the mercy of selling your shares to make the income, and I don't like to do that.
Right. So CIOW filled. We're still waiting.
But like
on
they
TSLW.
just had some really big news come out with the robo taxis, and then Elon Musk is going to going public with SpaceX. And I do believe at some point I've been beating if you've followed the podcast, you know that I've been beating the horn for Starlink to go public, and that'll go public at some point. Like he has a lot of shit in the works that will go public at some point. SpaceX is going to be probably one of the most highest valued companies when it goes IPO, if not the highest.
Yeah.
So they're going to have lots of money. And if you believe what Elon Musk says, he says that whenever they go public with companies that Tesla set the groundwork for, he's going to reward the shareholders of Tesla. So TSLW could be quite lucrative in 2026, 2027. Next one's NVDW.
NVDW.
Click on the little
NVDW.
drop-down box. Buy shares.
I am in the right one, right? NVDW.
And how much is in that one? NVDW.
We currently have 18 shares.
I have. Oh, no, fuck. I'll just go to this.
I don't know if it has
18 shares.
I'd have to go over. Oh, I guess I could go over.
Do 173.
We have $761. How much?
Do 7,500
$7,500.
minus whatever we have. What do we have?
Tim.
I'm very
761.
I'm very
So you
big
are-
on Nvidia stock.
Obviously, he's putting more.
We actually hold Nvidia stock in the main portfolio,
Oh shit! I did that wrong.
and I think a lot of people say there's an AI bubble.
So
but
7,000 ish. And 10.
Okay.
I think that's right. You might want to recheck my math. I have problems.
Like, what the? Whoa.
70. Hold on. I hit the wrong button. That's the problem.
So-
Minus 7. What did I say? 761. God damn it! I keep hitting 9.
67.39.
Oh, it's not even close.
What the hell?
67. 39. 40. Put 40 in. Apply. Order type limit. What did I just click on?
What are you doing?
I clicked somewhere to scroll and it clicked places.
Do 4109.
Okay. You want to add another share or no?
No.
Okay. Review. Place order.
I think that one's been pretty good so far. The NVDY has been good as the high yielder, and
Order status.
NVDA itself is really good.
TSLW filled. Very nice.
So click on accounts, go to positions.
Oh. No, is that how you shortchange that? Okay.
Now we want to click on PLTW. Do the same thing with PLTW. Now this one we're putting more.
A lot in because PLTW is
this
real
one.
good.
This one's been super good to me.
Okay,
What's the
PLTW.
current value of that one?
God. Numbers. 1823.
So 8177. We're putting 10,000 into this one. I like this one.
8177.
I don't like what they do, but
I don't like what they do. What do you mean you don't like what they
they
do?
basically just store data and just like give it to people. Basically,
Yeah.
if you believe like all the words.
Okay, what do you want? Bid and ask.
42.
42 even.
Yeah.
Okay. Another share.
Okay.
Yes.
Yeah, that's fine.
Review. Place the order. Order status. Oh, NVDW filled. Okay.
And the last one is the index fund of all of them.
Positions.
This is relatively new.
WPay.
I think it's only been out. Let me double check my notes here.
So you're actually taking the risk and going into WPay.
Yeah, it's because YMAX has done so well. Like, you know, everyone talks shit on YMAX, but we are literally up like 90% in YMAX. It doesn't look like it because if you go into
Yeah.
your screen here, it says
Because it has the gain loss.
it says it's YMAX. What the fuck? You passed it like 4 times.
Oh, YMAX, sorry. I
You
didn't.
passed it like 5 times. It
says we're down
It says we're
1729.
down 1,700, but we've actually recouped more than that in cash.
We have said multiple times that these gain losses in here, when you have the dividend payouts, like they're not accurate. You have to, that's why we keep our own spreadsheets of things.
WPay has only been around since like the end of October. Or beginning of October, I forget. But WPay, we're putting 10,000 into that, so 10,000 minus 22.19. What do we have left, I guess, will be my next question. Buy shares.
I don't know what you have left.
I'll tell you up in the corner there. What is that? 8,000?
We're putting the rest of it, 8209.
No, you want to put 130, so put 8,000 into it.
Okay. Limit.
do 43.50 is fine. Yeah.
43.50. Okay.
Review.
Review. I didn't even see a thing to do. Oh, that's all or none.
Yeah, we'll do I'll do the dividends.
They don't have a reinvesting button. They shouldn't have a reinvesting button.
I don't.
I'm just saying. I didn't see it before, but I didn't actually see it because it's not there. Okay. Oh, should I add one?
No. We need money left over to take out for the Coney experiment.
Ah, okay. So that's why we're actually leaving. I was going to ask about that.
Yeah.
Do you know how much we were supposed to have? Whoa, that one filled before we even finished. Still
150-ish.
waiting on PLTW because Tim dropped it down to a rounded
There
number.
we go. We just went
I'm
through $32,000 in, what was that, 10 minutes?
So easy to trade.
But that's why, like, when we talk to people, I always say have a watch list of what you want.
Yeah. When you actually go in, it's super quick. And you should always try to trade middle of the day when there's less volatility and crazy stuff happening because the beginning morning, 9 to like 11 or 9:30, whenever the hell it opens.
9:30 to like 11 is pretty
It's pretty volatile. There's most stocks will either shoot the hell down and then pop up or shoot the hell up and then pop down. So it's like it goes into those weird bowls, cup and bowl patterns. And same thing with the end of the day. People get crazy because they're off work or whatever's happening. So between, like 2 and 4, things start to get crazy again. Then you'll have and then you have after hours, which whatever. We like the middle of the day.
I've been following these for a while, so I have a pretty good idea what they pay per share on average.
What do we have left?
With what we have just put into this account, we're getting about $2,000 a month.
You mean for this next?
For what we just put in, we're getting about $2,000.
But total, if you bring everything into the picture, it's like 25.
It's gonna be about 2,600.
2,600. Okay. So we were shooting between 2,600 and 3,000 for our actual paycheck.
We were shooting 2,500 to 3,000.
Okay, 2,500 to 3,000.
Nobody shoots 2,600.
Weird people. It could be us if we had bills specifically. But we actually don't have that many recurring bills now that we don't have a house. We got phones. We'll have the Starlink once we hook that up.
We did get Starlink. If you never used it, I used it in New Mexico when my family was down. I used it and it's pretty sick. Actually, it's really sick.
We'll review ours when we actually do it. My brother had it when he was overseas in combat zone, so he said it was really, really awesome.
So check the PLTW order.
How do I do that?
Go up top, trade, order status.
Open. Okay, we're still open because the bid and ask.
You're gonna have to bump it up to 42.05.
So you just
go over to the right where that arrow's at.
That thing?
Yeah. Change.
Told you round numbers are bad.
42.05.
Review. Placed order. I wanted to see what we actually had in our
So it's sold at 42.05. Okay. Excellent.
Okay. No data found.
We'll go back into accounts, positions.
Yeah.
This is one thing that I've been trying to convey to people, the more people I talk to.
Oh, shit. Sorry, guys.
Is that the weekly payers are pretty sick. The monthly payers are pretty sick as well. Like if you have an option between getting paid every day or every week, getting paid every month, or getting paid every 3 months.
I'd prefer to get paid every month.
Every 3 months, they're more consistent, stable. The monthly ones seem to have they're very volatile and they have a lot of dividend cuts. So with the weekly payers, you don't have to worry about the dividend cuts because they're variable. They bounce around all over the place. So you never if you're looking for a stable income. I wouldn't load up too much on the weekly payers because 1 week you're getting 30 cents a share, the next week you're getting 17, the week after that you're getting 50.
Well, in an ideal world, if we had enough money to actually make what we wanted to make from the core portfolio, we would be all in the core portfolio unless in these risky weekly payers. We'd still be in some of these, but we would not have the majority or a large chunk of change in these. I mean, we might for just fun because they're fun. But as you get to the certain point, if you have more money, you actually get more into the safety oriented because you don't want to have say Yield Max or Coney.
I'm willing to go with this number here though. This number here, normal in my normal portfolio, I don't want anything over 5%. And that just goes out the window whenever you're basically just trying to generate a paycheck.
Completely different strategy. The goal of these is to get your initial investment back But now that we're using them for income, the whole theory is like a lot of van lifers, what they'll do is they'll like work part of the year and say for 6 months they'll save up and then they'll go live up that 6 months. Our perspective was if we had a lump sum of cash that we were going to eventually just spend anyway, if you put them in this and you could actually live off of that extended periods of time, if it goes past that 6 month period, like you stretch that money further than you would have had you just spent it. So like the mindset of this is completely different than it is like your investing portfolio. Like these really aren't for valuation growth at all. They're literally just for the income component.
But you can use macro trends to your benefit because they have so many.
Because they have the underlying stocks.
You
yeah.
You can pick and choose. Like, oh, okay, like I think AI is going to be around for another 3 years. Well, who supplies a majority of the chips to the AI company? That's NVIDIA. So NVIDIA should be pretty good for the next 3 years. So why not buy NVDW where you make, I don't know, 80%? Now the taxation implications, I don't know if that's her thing. I don't really pay attention to the tax stuff.
Well, it's like any normal paycheck, and this is what I was explaining to my friend. Stocks in general are considered passive income, so that you don't have to pay Social Security, you don't have to pay all those extra things. If you look at your paycheck breakdowns, if you're a W-2 employee, you have like about 15%, and if you're a self-employed like person, you also pay that 15% in small business tax or whatever the hell it's called. So that's that extra 15%. And then you have your normal tax bracket stuff on top of that. So when they do the apples to apples comparison, it really isn't apples to apples. If you're looking at W-2 income, you're still looking at just that tax bracket, but you don't even realize you have more coming out of your paycheck because of Social Security and all these other things you're paying. So when you do this, when you do the investing thing, yes, you're still paying taxes. But like when I first started looking into this, like everybody's like, oh, you pay more, you pay more, you pay more. They're talking about capital gains, and capital gains are at your normal tax bracket. I just said racket. It is a racket, but you're still paying the same thing. So would you rather hustle for that money, or would you rather just get paid like for owning these? Either way, you're still paying taxes. And all you have to do is to make sure you have enough is to either, set some money aside into a savings account at a proportion of each one of these at your normal tax bracket from your payouts, or you could just like close to your tax time because you have a span. If you file your taxes, like you just make payments with your yield max over that time frame. Like you can do either or. It's up to you. So like the difference is like as a W-2 employee, you already have tax coming out of your paycheck. So that's why people get those refunds. You don't get a refund when you're investing. You end up paying in because you didn't ever give the government the portions over time. Now that's something that screws a lot of people up in the head. But the reason they do it that way for the W-2 employee is because the government wasn't getting their actual taxes. So that's why they started doing it up front. But if you think about it, you're giving them a 0% loan on your dime, and they're paying you back with 0 interest. To me, that's stupid. You should be making money off your money and then paying them whatever from there.
Yeah, tax refund on the scale of shit that sucks. Tax refund is barely behind normal bank interest.
It's really bad.
Because you're doing the same exact thing for the bank. You're giving them a 0.1% loan, and they're actually generating like 7% off it.
Whatever current rates are. So it's like that gap, it's ridiculous.
So that was like one of the things that I had to learn.
So when you
I first started doing this was like, dude, you don't want money in your bank account. I understand that a lot of people to a lot of people that is an uneasy feeling. They feel afraid, like, oh, I have to have my money somewhere that's like insured.
And again, that's a perspective, because when you realize if a bank goes under, they have to liquidate their assets, and then you're like, even though you're technically guaranteed, the bank only gives you what it gives you, and then the government will like whatever, but it has to go through that crazy arbitration process, which can take years. It's kind of like probate. If somebody dies, it takes for freaking ever as soon as the government's involved in it. It's like, do you want your money hung up on that? Is that worth that $250,000 FDIC insurance? Is it? And then again, with the rockiness that's been happening with the government, do they even have the money to give you that money? Will they in the future? Don't know. To me, the uncertainty is the same thing. So you can choose to take life into your own hands and manage your own stuff, or you can choose to continue to be the W-2 employee. And again, no harm, no foul. If like the W-2 route works better for you, by all means. And you can still do a hybridized approach where you can actually like withhold more taxes from your tax thing to make up if you're in the in-between where you're still W-2 employee working and you're starting these investments and you're growing these up. You can turn your thing higher so they're withholding more, so you're paying less because you're making up for the fact that you have the dividend income. The other thing we should probably say is some of these do this return on capital. Like when you get your 1099s in your brokerage account, we'll go over this later because it's the end of the year and we're going to be getting them in, I guess, the first month. I think Schwab has to have it out, at least the original copy or first copy, before the end of January, by the end of January. And when we looked initially with the Coney one, it was 100% dividend payout. But a lot of these other, like YieldMax and Round Hills, do return on capital. Return on capital is not... Return on capital is your original money you put into it, so it's non-taxable because it's already been taxed, which is nice. But you also, like if you're doing a tax loss harvesting, that money is also not eligible. So it's like, I don't know, I still haven't looked into the rhyme or reason of why they pay out different proportions. I'm sure there is some like logical thing that they do. I don't know why they just don't do all return on capital initially, but who the hell knows. So the dividend income is really the only thing that gets taxed. If it's ROC on your 1099, that's non-taxable income, and you'll put it in the appropriate boxes when you go to do taxes. And I can't give you the estimates for that. So one of the commenters on the video we did on YieldMax said that you can look them up under their thing. I haven't looked that up yet, but once I figure that out, we will do an episode and I'll put links to where you can find that information. But as of right now, I would just assume the max. And if not, then like you're getting more.
I just want to make one more point before we go. You see, here's what we have invested in this account.
$52,196.
We're going to be generating around $26 to $27.50 per month.
Per month.
If you extrapolate that out, like with your life, like so, when people say you need 1.5, 2 million to retire, I personally think they're full of shit because you don't.
I think that is either the old modalities that are outdated, that no longer work, or it is the presentation or the perspective that is being pushed on majority of people to keep people in working positions as W-2 employees so that they're contributing to the government and big business and capitalism and whatever.
My philosophy is if you have $300,000, you could retire pretty comfortably.
Yeah, so the $1 million thing is not even, like, even if you wanted to be conservative, if you did 10%, $1 million at 10%, if you have that right now and you're still worried about investing, it's actually 880, I think it's like 8,800 a month, I think it comes out to be. If you did it at 10% with the dividend growers and like the really, really conservative stuff. But if you add these in, like you can bump that up significantly. So I forget what the heck my equation was, but you basically take whatever you need a month. Let's just pick a number out of our butts, say $5,000. And you divide it by, hold on a second. You multiply it by 1,200. And then you divide it by the interest rate, that let's say 18%. 18%. Okay, so if you did that, you would need $333,333. So if you were making 18% between having a good core portfolio and pulling in some of these high yielders, and you say you were actually making 18% in dividends a year and you needed $5,000 a month to live, obviously pre-tax, you would have to invest $333. So that equation, again, it's factoring in the year and dividing by and like taking the interest rate into account. So it's easy for people, so you don't have to worry about decimal moving. You take whatever you need a month, you multiply it by 1,200, and then you divide by the interest rate with no decimal.
Interest rate, like your
return
on your investment.
Yeah, return on your investment. So if it's 10%, it's 10. You divide by 10. If it's 20%, you divide by 20. I don't remember.
It's like, that confuses people.
But I'm saying that's why I said you don't need to move the decimal. I already incorporated that in the 1,200. So it's the 1,200, you multiply your monthly by 1,200, and then you just divide by the interest rate that you think you're going to get.
Your return rate, not interest rate.
Yeah, sorry. Your return rate of your dividends. If you, I forget, I think ours was like 18 to 22%, or to 22. It fluctuates every year.
I think I started with 2,000 in my brain. Like that's
for our target?
Yeah.
So our target originally was $2,000 a month, and or what we were making from a dividend perspective, I think is like 18 to 20%. So I usually go on the low side for conservative reasons and just do 18. So like for us, so technically we're taking 2,500 plus the core portfolio, which I think we said yesterday was 1,900-ish. So 1,900 plus 2,500, we'll just round up. Well, I'll just round up to 4,500. because you said 26. But that's higher than our 3,000 that we originally like targeted at. But that's because we want to reinvest in compound to just continue to build out that safety portion of the portfolio. So we're going to be reinvesting that $1,900 a month, and we're going to be trying to live off of the 2,600 or whatever.
We're going to live off of this.
Well, we're going to be living off of in that in between. I mean, there's going to be some months that are extenuating. So like if we do plan with some budgetary constraints, like we might sit a couple months in like a certain location for extended times to stock up a little bit extra money to like go do some of the adventure stuff that, you know, would put us over budget for that month. Because obviously we can't pull money out of our butts. But I'm also going to be building out a like automated payment system. So if you have automatic payments, like having 3 bank accounts and then moving money automatically so that you never actually spend more of your discretionary than you intend to. And so you always have your credit cards incorporated if you're choosing to utilize credit cards for cashback aspects.
Oh, if you guys didn't watch that podcast, you probably should watch that one. That was a really interesting
Which one?
The credit card one.
So the credit card episode that we did do for the podcast was about basically how to get the most cash back for stuff you're already spending money on. So it's basically just getting free money back for stuff you're already getting or already spending money on. And if you do it right, you can potentially get a full month of expenses covered in cash back points a year.
But let that sink in. Everything, you're basically spending what you would normally spend. You just put it on a credit card, then you're paying the credit card at the end of the month.
You're paying it off so you never accrue interest, and you just rack up points.
And you get a month free.
You basically, you got a month free.
So that's a pretty good deal.
Oh, that's a pretty good deal.
Buy 11.
Now, granted, you have to have multiples of credit cards because you need one for gas, one for groceries. They don't all offer 5% across the board, so you do have to get creative. And if you have stuff that's like things that do not have high cash back, like you'll be limited. But there is like the Citi, I don't know where my wallet went. I think it's right there. The Citi card allows you to have 5% back on your top category. So like that's the one where you kind of can like filter in with that. I think that's it's under that pile. Oh no, it's out on the table. Never mind. That's the one that I think we're getting the groceries on because I decided to go with AAA for the gas one because they only allow you to have one, and one of them's for groceries 5% and the other one's for gas, and that one it was better to do it that way around. But if you're anti-credit cards and you have issues like overspending, don't go that route because you're just going to end up like sinking yourself further. But if you have the discipline to do it, or if like you just spend what you normally spend and automatically pay them off, they can actually be an asset. So we don't necessarily agree. We don't necessarily agree with the people who are anti-credit card unless that really needs to be specifically for you. 2,500. 2,500
times.
I can't even type.
1,200. 1,200? Well, you said 1,200.
Oh, and divided by.
Do 10.
10?
Yeah.
$300,000.
That's a very conservative.
Okay, so if you needed $250,000 a month.
$2,500 a month.
$2,500 a month, sorry. For what we were trying to like live off of as our paycheck. At 10% interest, which is the conservative side.
10% return. Stop saying interest. It's return.
Sorry, return.
You'd have I just put 10% in because that's generally like historically what the S&P index fund returns.
It's the index fund, it's the markets like as a whole.
But if you do just do 15 instead.
So that would come out to you need $300,000 to invest to get that $2,500 a month with the dividend strategy. And you said if you want to do 3,000?
Do 2,500 times 1,200 divided by 15.
Oh, the 15%. God damn it.
What are you doing?
Dude, my numbers divided by 15. Okay. So you'd need 200,000 if you actually were making
200,000 if you're making 15 to get a return of 15%, which is a little bit better than like the index funds. So you'd have to do a little bit of these high yielders, little bit of stuff. But like what my very doable biggest point is, dude, you can for real retire on less than 500,000.
Yeah, because the goal with the million for most people is the 300 or 13. Oh my God, $3,000 a month. We probably should have been using that because the million would be the 3,000. Because that's with the 10%, I think. 1,200 divided by the 10. But like our strategy, 360. But the reason it's so much for the $1 million for the $3,000 a month is because of the 4% rule, which is, in our opinion,
we had a podcast about how that's
absolutely psychological warfare on the human.
Rule that has no place in
really, really bad. So what they preach, if you read a lot of the investing books, what they preach is you hit your $1 million and then you take 4%. That's where that $3,000 and that $1 million comes from. It's 4% of your lump sum value because you have to sell off your stock to be able to actually get that $40,000 that you're then dividing across 12 months to get your $3,000. Is a little over $3,000.
My problem with that, like,
but that
honestly,
is subjective to the valuation of the market at the given time, and you have that lump sum that's going to be declining year after year. If you go into retirement and to cash out your first year when the market dips, even if it does it in the first 3 or 4, if it really, really comes down in value, you screw yourself because you're taking out so many more shares than you would if the market went up. You are subject to whatever the hell the market is doing. The market is volatile AF. You cannot guarantee that strategy. Like, this strategy is so much better, and you never have to sell shares of your actual stocks.
So, well, like, what we did is backwards. Okay, most
what
people,
we did is backwards?
Yeah, most people will save up and to retire at a certain lifestyle. We basically created a lifestyle and then made an investment plan that funds it. Mm-hmm. It's like 180-degree difference.
I think it's a better strategy, and we're using the month-to-month comparison.
Now, granted, like the lifestyle may change down the road. We may want to do something different, and then we'll have to tweak the investing strategy to fund that new lifestyle. But what we're about to embark on for at least the foreseeable future, the lifestyle was we need $2,000 a month. How do I get $2,000 a month? So then I created an investment strategy that would generate $2,000 a month to fulfill that lifestyle. Whereas other people will work, and they'll say, well, my lifestyle is this, so I need to make this much money.
But they use that 4%
Actually, what they'll do is they'll like
some huge astronomical
when they retire,
number.
they'll be like, I have this huge number. Now my lifestyle, to pay for the lifestyle I currently have. That's why they work so long.
But it didn't incorporate inflation.
They don't want to delete anything from their life. Like they want the house they want the food they want the cars they want the travel that they want. So they're like, that's why they work so long. It's because they're uncompromising on changing the lifestyle to fit your current investment thing.
Well, you don't necessarily have to change your lifestyle if you change your investing strategy and it lines up.
If you want to retire early.
I was gonna say, but you also have to factor time horizon in here. It's actually 3 different things you have to play around with. Either you change your lifestyle a little bit to, like, you know, give up the stuff that doesn't matter as much and double down on the stuff that's actually, like, fulfilling to you, or you change your time horizon, or you change, like, how much you're investing or your strategy. Like, those are the 3 pieces you're essentially playing with. And we just looked at it as, okay, well, we're okay with giving up, like, having a stationary house because it makes no freaking sense for the fact that we want to travel as much as we do. The van life thing makes so much more sense, and we're willing to live with the discomfort that most people aren't willing to live with because we're basically living heathens. Like, we kind of just roll around in the dirt as it is. It doesn't bother us at all, and that's a very, very easy trade-off for us because it just doesn't matter at all.
I'd rather live.
Yeah, so we're more experience focused.
The life that I want to live with experiences and
I hate traveling with public transportation because you're like subject to a time frame and a schedule. And I ran into that the last time we went to Greece. That was such a pain in the ass. You have your hotel booked, you have your freaking time that you're on a bus or a train, and the freaking ferry is late, then you miss the train, then you have to get a taxi, and then the people aren't even there to let you into the freaking Airbnb you're in. Like, it's such a pain in the ass.
Okay, so now I have a hypothetical.
What's your hypothetical?
Let's say you're 27 years old and you have to put $50,000 into an account. Would you be willing to trade like 3 to 5 years of your prime years where you didn't have to work, where you could go do what you wanted to for $50,000? That's like a worst case scenario. Say that everything goes to zero. Everything we have here goes to zero, but you only get 3 to 5 years. But you have to put $50,000 into it to enjoy your prime years. That is like the basic premise of everything that I've done. Is like I don't know what the probability is, but there's a probability that all this shit fizzles out, and then we have to like tap the other account because this doesn't work. But I'd be willing to trade $50,000 for 3 to 5 years of no financial worries and just doing whatever the hell I want to do when I want to do it. Yeah.
So for example, that $52,000 that we have in this account, if we would be actually spending the $2,500 a month that we're allotting for, we would only be able to live on 20.8 months. Live for 20.8 months until that went to zero. So if this strategy outlasts the 20.8 month mark, it pays for itself. Like, it's more worth it than doing it.
But that's why, like, when we first started this journey, we said, like, you have to know yourself as a person, as an investor. Like, I'm willing to take a $50,000 risk for 3 to 5 years.
Yeah, and what is that, coming back to work and working a year of your life at, like, average income? I'm willing to do that to basically potentially have a full life of freedom.
But then we tweaked it to, like, make sure the other account would be able to fund.
Because I told Tim, I go, my biggest fear, because I'm a type that, like, once I'm done with something, I literally cannot go back to it because it's so disruptive to my nervous system. system. And like even thinking about going back to the government created like massive nervous system dysregulation in my system, nightmares, all sorts of crap. Big no-no. Big no-no. And I was making like $90,000, I think it was $96,000 a year actually when I left there. And we've been working with my dad part-time and we've been investing. So it's like we haven't even been working full-time. And like the part-time thing, after we did the first trial of van life for 5 months, we can't go back. We knew that was what we wanted. We doubled down. I do highly recommend, though, if you are going to start a life either similar to ours or a massive change from what you're doing, try it out before you actually, like, cut off your job to make sure it's really what you want to do. Like, don't be like the other van lifers that just go out, buy a freaking new Mercedes van for $90,000, go into all of this ridiculous debt, go out into the woods, and then realize they're super extroverted. They hate nature, they hate dirt, they hate spiders, or they hate their partner, and then they, like, have breakups and then have to, like, offload everything at a fraction of what they paid for it because of valuation decline. Like, don't do that. If you want to practice van life, either, like, figure out how to make it work in your car, rent a van, or just borrow somebody else's and just do a trial run.
That's how we came across this. So like the backstory quick, if you knew, we literally went and we went down to the Smokies. We used to camp in the trunk of a car. Like it was one of those where the back seat went down and we could put like blow up pads and the sleeping bags in the back.
And that was a complete fluke.
And that's how we got into this. I was like, well, this is fucking cool and this is probably pretty cheap. So then I looked at like what means there were out there, and then I stumbled across van life. I was like, oh, but then in my opinion, again, my opinion, not an expert, but in my opinion, they do it wrong. Like, you shouldn't have to work a job or rely on like YouTube channels or rely on
gig hustling.
6 months on, 6 months off. Like, if it's a lifestyle, you want to create a investment strategy that funds the lifestyle.
I guess we should say that strategy might be good for people who love their job and they have the ability to do that sabbatical thing and they want that change with the duality. But for us, like, we didn't want to work a job anymore. We wanted to completely decouple, like, money from what the hell we want to do.
And I'm sorry, pooping in the woods is awesome.
So much fun.
It is awesome. So that would be like one of the few things that I would bring up to people, like if they're thinking about alternative living, is
you can't poop in the woods.
Does pooping in the woods sound fun? If it doesn't, then you need to
probably a red
figure
flag.
Something else out, because pooping in the woods, like we have a little poop bucket, right? And I just sit there in the woods and like, oh, this is so nice.
And we're not telling anybody that they have to do van life. Like, that's not the thing we're preaching. Like, we want people to figure out what is what
they want to do.
What is their life? What is their ideal life? And then you can, be able to decouple the money thing.
Maybe it's our Airbnb travel where you go like 1 month you sleep, get an Airbnb in the Poconos, and then the following month you go to like say Tallahassee and you live there for a month. Airbnb hopping you could totally do with the same investing strategy because you need X amount each month for your Airbnb.
Yep.
But you could totally do that, or you could do the workpacker thing, which
and I was even saying, even if you're not like don't want to be independent location wise, like you might very well just want to stay at home and like rear your family. Like, that's absolutely an alternative too, and then have the time and space to be able to not have to work while being a stay-at-home mom or stay-at-home dad or whatever, and then having to side gig hustle in the evenings to like make it all work, and then having to sub out daycare. I don't know. That whole thing just doesn't make sense to me.
But
this
back
allows
to know yourself. Like, that was like one of the very first episodes we did was investor know thyself.
The other one that really is a main passion project for me is the fact that, like, if you're an artist or a creator or somebody who is like a multi-passionate, you have a problem sticking with things and you need the freedom to pivot, or you need the freedom to not monetize the thing that you're working on because it's more personal. The thing that you're working on is more for you and the journey, the experience. So when you like take away the need to monetize what you love, you don't destroy what you love because of the money. You don't sell yourself out because of the money. You don't like compromise on your shit because of the money. That's something that we really, really, really want to help people like who are in that situation not have to do that. And you can always choose to sell the stuff you want to sell, but you can be pickier if you already have another supplemental income stream to be able to say no. Like, this strategy gives you the permission and the ability to say no. And that's huge. So
the first question that I ask people whenever they come to me for advice is, if money is not an option, like it's not a problem, it's nothing that you have to worry about, what would you do?
Because if you'd make different decisions, if you weren't like,
that's
I have to support my family. That's a question that I think
everybody that sees this should like dwell on. What would I do if money wasn't a problem?
Yeah, if money wasn't part of the equation.
Maybe it would be like hiking the Andes, or maybe it would be like just visiting your mom and dad. And
it could just be the fact that you want to write a book or something, like doing whatever you want, spending time with your grandkids,
playing video games, whatever the case may be. Like, what would you do if money wasn't a problem?
Although I will tell you, one of the things I ran into, like once I finally like didn't have to work, now when I wanted to hang out with my friends, they're like, oh, well, I have to work, and I'm like, well, I'm free, but you have to work. So now it's like you have to work around their schedules. It's like, wow, this kind of sucks. So it's like you want your friends to become like decoupled from money too, so that you actually have time to hang out during like daytime hours.
That's why we do this. Like, I'm trying to, like, I know that it's not the norm. I know that what we're saying is not what the financial experts would say is a good idea. I know that the valuation of some stuff is not like the norm. I know it's not the norm, but like, we want to reach the people that want to try
to live a not
$50,000 risk, and if it pans out, it's life changing.
Yeah.
If it's not, then
as long as you make it last past what you would have just spent out of, it's really no harm, no foul. Like I said, if we would have took that $52,000 in cash, we'd only be able to live 20.8 months. So if we can make it
2 years,
more than if we can make it more than 21 months on the payouts from this, it literally is more than a break even, because if you would have just took off work and just spent that cash, it would have gone to zero anyway. This is at least giving you a potential for like investing in, say, small businesses, or like buying rentals without having the headaches and hassles and upkeep and maintenance and depreciation of, you know, small businesses. And
since I know they want to know, if money is not an issue, what would you do?
You asking me?
Yeah.
Dude, I want to be able to wake up and do whatever the hell I want to do at any given point, because I literally change my mind so much. Like, some days I want to read, some days I want to hike, some days I want to like learn blacksmithing, some days I want to go paragliding, some days I want to do absolutely nothing and be completely content with it. Some days I want to do all of the above in the same freaking day.
Interesting. I knew all that, but I would pretend like I didn't. Interesting.
And that's been my biggest issue, is because like I don't ever want to be doubling down on one thing, because as soon as I freaking like get completed with it, or I learn what I need to learn, my interest goes away. So it's like I've tried to start so many businesses, and like there was a part of me that knew at one point that it was going to be a trap just as much as W-2 working was, and it just wasn't. I knew it. So it's like I either self-sabotaged or I walked away, and from any outside perspective I looked like a failure, or I looked like somebody who gave up or who was too scared to continue. And yes, there was a fear component, but it wasn't a fear of succeeding. It was a fear of succeeding because of the trap and the obligations that it would ensue. I have major issues around obligation, severe ones, because I have been obligated to so many things my entire life, and I am so done being obligated. I want to do what I want to do, and I want to love what I'm doing every day.
Yeah. And since they want to know, what would I do if money wasn't an issue? I want to do what I want to do.
The same thing.
But I also want to find the people that I can teach to pass on the lessons, so they can make the world a better place. I don't personally want to like change the world, but I want to find the people that do.
Well, and that was the other thing. When we did the van life thing the first time, I thought it was all about traveling and being able to do whatever, but like I had an epiphany in the desert that basically was like, what is the point of figuring all of this out if we're not helping other people achieve the same, like,
that's why we've done this podcast
vision
for so long. It's because I want people to learn from me, and then they can teach other people. So like you all can change the world, and I can just do what I want to do, but I actually helped you guys change the world without actually having to do all the work. But I do all the work.
Exactly. And if you guys ever have questions, like, this is what we're here for. We're here to help people figure out their specific lifestyle design or whatever, and make it all work, like figuring out their time horizon, their investing strategy. And it changes. Everybody has different, like, everything. And I love figuring out the like special hybridized version for every individual, because it's always different. Like, it's so fun. And the other thing we're going to say is we are going to we're going to start doing live streams on a weekly basis for Tim's top 10 picks, because on Tuesdays, because that is how we actually find a lot of the stocks at undervalued prices that we didn't even know existed. So we're going to continue to do that online. So if you ever have questions, you ever want portfolio advice, like, you can hop on those live streams and actually get the intimacy component and questions answered right then and there. And then we're going to be updating you guys on what happens with this portfolio, how we're spending it, like how it's working out, if these yield max and the round hills are
we're going to have a monthly
up.
report card, like, here's how much we made in the income portfolio, here's how much we spent. So like, we're actually going to take you along on the van life journey from the financial
perspective. Yep. And
Like,
how we're
here's-
living, how we've aligned, what we're spending on, like what we're doing with budget or not budgeting, because there's
Because
definitely.
they never talk about that.
No.
Like all the stuff I watch, like every now and then they'll brush up on it. Like, well, how much do I spend a month? And they just do 1 month thing. We're actually going to have a rolling, like every month. You guys are going to know exactly what we're spending, exactly how much we made, like, what we did with the leftover.
Yeah,
Like,
or if we're sitting on it, if we're sitting in the
It's going to
woods.
be all transparency because I want everybody that wants to see.
Yeah, the
that
living
it's-
example.
It's feasible to live on $50,000.
Yeah, the living example, because we're leaving at the end of the
Even
month.
if it's a short time, I'm hoping that it's a long period of time. But even if it's a short amount of time, 3 to 5 years, you still can like live on $50,000 for a short amount of time.
Well, actually, this is a new experiment, right? Seeing if we can actually make this whole thing last more than 21 months.
It is.
That'll be the proof. So this is the new experiment.
And
Since
then one of the
Coney
big
like,
things
failing.
is we're leaving here to go to New Mexico so that I can prepare for a bike race. And I might actually take like a camera along, and so you guys can watch me suffer because apparently that's people like to watch me suffer.
It's gonna be super funny.
It's the Tour of Gila. It's an amateur race, but they actually have like a UCI race, and it's a 3-day race, and it's going to be pretty
It's at the end of April.
pretty strenuous. So
Yeah.
I'm like, once we get out of here, I'm going to start my training for that. Where there's a diet component, there's a flexibility component, there's going to be a training rides component, and there's going to be like all sorts of different components to go into it. And like the whole objective is to finish the race. I ride my bike every now and then. I don't ride as much as I'd like to, but so A is finish the race, and B is not finish last. Those are my two goals for the Tour of Gila in April, and you guys will come along with that as well. And that's part of the money from this is going to fund that. So it's gonna be kick ass.
It's going to be really, really fun because we're going to start actually building, because while he's training, I'm going to actually start building out all the pieces of like the investing strategy, like where you plug in what, depending on what you're doing. I'm going to really double down on like the human needs component, which is like your core thing that's like hijacking you. We're going to start dissecting and decoding all of that. We're going to be rebranding the podcast and actually splitting it out. We're going to keep this one for our personal journey and our updates with the money component and like what the hell we're actually doing, how we're pivoting, what's working, what's not working. And then we're just going to have the money rewired strategy, or like one where it's going to be all about
This podcast very well, and I haven't decided yet, but this podcast moving forward in January may very well just be a live stream like once a week. Like here's the top 10 list, or here's how much we made, here's what we spent this week. It's going to be like, I'm pretty sure this podcast is going to go to a live stream because I don't like the recording the podcast when I can just talk to you about all the data and everything. It just seems easier and more efficient.
for me, but whatever.
And then the secondary one, the money rewired, where like
that's going to be where we actually continue
aligning yourself with your spending and your saving and your investing, and
and we're going to start analyzing other
lot more of the
investing
psychological.
strategies, other like approaches. We're going to show what works, what doesn't work, what's outdated, what's like causing like issues, dysregulation. We're going to continue to show like Tim's investing strategy as it evolves over time, because nothing is stagnant. Everything is always changing.
It shouldn't be stagnant.
Yeah, everything is always
changing. If your
changing.
investing strategy is stagnant, that's not a good sign.
Everything is dynamic. Everything is a living system. So it's going to be continuing to iterate with that. As people start actually implementing strategy, we start getting reviews and testimonials. Like I have a couple people that, like I said, she texted us, like we're helping her do that whole thing. We're going to start actually posting so you can see live examples. It's not just us. You can see other people's stuff. It's going to be really fun, really interesting. And
well, we have like right now we have four different people that we do stuff for. We have the retirement account for her mom. We have retirement account for the van life people that are on YouTube. We have her uncle, and we have one of her friends, and they all four have different goals.
Different
All
goals,
four
different
have
strategies, different
and
time horizons,
So like it's,
different comforts.
I'm assuming between the 5 portfolios, you can find something that resonates.
And there'll be more as things start trickling in. But I'm going to start like hosting classes. I'm going to start building courses.
That's one of the things I want to do on the road. Is I actually want to like sit around a campfire.
And we're going to actually
discuss stuff
we're going to
with-
build communities out, because that's
and
another
be
really
like,
big
hey,
piece.
we're in X area. If you guys want to shoot the shit and talk about investing, here's like I can help you guys work through your things,
Yeah. So if we're
or
actually
you
in
can
your
help
area,
me learn new things.
Yep.
It's not.
Swapping.
I don't want it to be a
I
one-way
love it,
street, because
right.
I'm assuming other people have different ideas. There was a guy on yesterday that was going to short all my stuff. That's cool. If that's what they want to do.
That was fine.
That's cool. And there's another guy that like really has a problem with not wanting gold in our van.
Yeah.
We're not for everybody, but I never claimed to be for everybody, and I never claimed to be an expert. I'm just a dude that's like literally creating an investment strategy for a lifestyle that I want to live, and I thought that it would be pertinent to other people who want to create an investing strategy for lifestyles they want to live.
But we're also really good at problem solving. So it's like,
I mean, I can get a degree and put it here if you want. I did graduate college
I have a master's
from Penn State,
but it has like no relevance.
That helps with people. Like, I mean, here it is, Penn
Who
State.
cares? yeah, whatever. But I do actually really like problem solving. So it's like if you actually have specific situations you're trying to figure out like your specific like dialing in thing, like bring it to us. Like, man, this is gonna be so much fun. I love helping people like get their
But
stuff figured out.
this like here is the conclusion of the first part of the journey. Like it was the developing. Actually, it was having.
We
the
didn't
money,
even really know this is how it was going to transcend into.
having money to invest, and then developing this investing strategy for the money for the lifestyle we wanted. This part of the journey is about concluded.
Yep.
So now
this chapter.
Now
has
we're
come to
doing a
conclusion.
different journey where it's going to be the stuff that we
Living.
learned and prepared to use is actually going to be implemented and being used. So it's
Yep.
going to be, I think,
The
to
full
me,
embodiment.
that's very exciting.
Yep, the full embodiment of the full
Because
thing.
at that point, when we're on the road, it's no longer theory. It's practical.
Yep. You'll actually get to see the month of
We'll
what
see
we're
how
doing.
it happens. We'll be like, oh, so I can live on $2,500 because we'll be like, dude, we went to the grocery store, we got all the food we wanted, we had paid for this much in gas, and we went to all these different like locations.
National
we did
parks.
this, we did that, we did this. So this is how much. 2,500 or 2,600 or 1,800, whatever the case may be for that month. This is how much that actually fueled for the month, and it's going to be very exciting because I don't think anyone does that.
Yeah, we're gonna be doing some fun shit. Like I want to race car drive. I want to
race car
paraglide. I
driving
want to
is
do
fun.
all sorts
And
all
paragliding, I
sorts
want
of
to do some
stuff.
paragliding, and I want to
Blacksmithing.
I want to do blacksmith. I want to
Glass
do
blowing.
like
A lot.
I'm guessing deep sea diving just to like see like treasure hunting. I don't
Well,
know.
I have
That
a
sounds
fear
fun.
of water. I have to figure that out. But this will give me the time and space to figure that
Treasure
out.
hunting, that sounds like a blast.
Treasure hunting sounds super fun. Like gem mining. There's so many things to experience, and like that's the whole reason we decided to do all of this.
Yeah, because
it's
I
like,
concluded
I
when
just
I
want
said
to do it all.
investor, know thyself. I was like, what does thyself like? And I was like, I
Everything.
kind of want to do everything.
Everything.
I want to learn as much as possible and experience everything I can before I die. I can't do that sitting in a cubicle.
Right. And that's where the van thing is. Like, this isn't really about van life. This
I mean,
is
I
more
guess
about
I
the
could
experience.
be like someone that goes on Instagram, like, oh, I guess it's like a third party type of, I experience like them treasure hunting. But to me, that's
Nah,
not,
dude,
that's
wanna
not
be
the same
there.
thing.
Tim's
'cause
gotta touch
I have
stuff.
to touch everything.
Touch stuff.
So that's that.
So that's
That's
that.
this, and we'll see you guys on Tuesday. We're going to do a live stream on Tuesday where I do
Yep.
the top 10 chart.
So bring your questions.
And
If
then
you want us
any
to
questions you
evaluate
have.
any stocks or ask for us to dig into financials of anything because you don't want to, like, bring it. Like, we'll literally talk about anything. Tim will build his list on live, and then any questions you guys have, like, we'll start just answering whatever. I don't know how much time we'll block out to that. I don't know how long that takes you to do.
Like half hour.
Okay. So, like, we'll do at least an hour.
If you haven't, you should probably subscribe
hour and a
to
half.
the email because the email actually has the list. So if you don't want to watch our ugly faces, I mean,
Yeah, we'll get to that in the
ugly
live
face, she's pretty, but I'm ugly. If you want to see my ugly face, then you just subscribe to the email and you'll actually get the list without any of the I guess, the visually hurting faces.
Oh my God. Shut the fuck up. All right, guys. So we'll see you either back on the podcast going forward on the new podcast. Again, I will post everything once we get everything up and running or on the live stream. So, like, just catch with us. We'll see you later.